Welcome. My name is Jonathan White. I'm the Global Head of Fund Sales at the Intertrust Group. We're here today to talk about private credit with an esteemed panel of guests who really are going to get their arms around one of the fastest growing asset classes in the spectrum of alternatives today. And we're going to be talking about the growing pains and challenges. Before we start, I'd like the panelists to introduce themselves, starting with John.
Thank you, Jonathan, and thank you for having me here today. My name is John Finney. I am the co-founder and CEO of a company called Convergence. Convergence is a data and research company, and summary level overview of the company is we've got 280,000 funds mapped to about 46,000 GPs and advisors in our database, and we provide services and insights, if you will, into that data and trends in the market to roughly 200 clients globally.
Thank you. Jess, please.
Thank you, Jonathan, and thank you very much for inviting me on here.
You're welcome.
My name is Jess. I'm the founder and the CEO of Briarcliffe Credit Partners. We are a placement agent within the private credit space, so we are exclusively dedicated to private credit, and probably the only dedicated private credit placement out there.
Thank you. Drew, please.
Likewise, thank you for the invitation. I'm Drew Phillips. I'm a partner and the Chief Operating Officer at Atalaya Capital Management, private credit manager. We've been around about 15 years, focused on special situations, specialty finance, some corporate and real estate investing as well.
Thank you very much. So John, let's start with yourself. We talked about this accelerated growth, fastest growing asset class in the alternative spectrum. Can you add some color to that, please?
Absolutely. I mean, when I started my career in the 90s in the alternative space, it was occupied by perhaps 400 or 500 advisors. Credit was always present, but it was never front and center. It was clearly a diversification play and something to provide, again, additional uncorrelated returns. Never felt it would grow the way it has. In the last 5 years alone, the growth has been explosive, not only in terms of assets and allocations, I'm sure Jess will talk about that, but at the end of the day, just in general, the number of advisors that are out there offering credit, pure play credit, like Atalaya, for example, it's almost 2,500 of them. And don't get me wrong, are they all serious bulge bracket players? No. But there's a lot of optionality out there in the space. And there's almost 15,000 funds offering various dimensions and flavors of credit. When you look at the alternative growth space in general, compounded annual growth rates over the last 5 years are ranging between 6 and 8% on funds and assets. Credit is lapping that by a factor of 40%. So 12% CAGR on the funds out there, and obviously allocations catch up over time, but what we see is a significant growth in the allocations to credit of all flavors. So quite startling in terms of the magnitude, and as Drew and others will talk about, the variety is creating significant opportunities, quite frankly, for service providers and other participants in the market to help the advisor and the GP do that work in credit better.
Thank you. Jess, over to you. When we were talking the other day, many different flavors of private credit. Some are getting more saturated than others, harder to get returns. Can you give, sitting between the investor and the managers, give your perspective of where the interest is, why, who's winning in this space?
I can certainly give it a good shot. I'm not necessarily sure I can tell you who's winning, but what I can tell you is before Dodd-Frank came in 2010, private credit was really about distress for control and mezzanine. Obviously, Dodd-Frank came in and changed our world to the better in certain senses. And since 2010 and up till maybe a couple of years ago, private credit was really all about direct lending. And direct lending is a great asset class. It continues to be the core of private credit. But there's more to private credit than direct lending. And that is what we're seeing now. So what we have seen over the last 12 years is the fact that LPs have kind of stuck up on direct lending. They've chosen their partners and who they want to work with in that space. Well, what they're doing now is they're looking for more what we would call uncorrelated strategies. Right? Direct lending is very much about healthy EBITDA of corporations, but there's a lot more to private credit, and that is what we're seeing a huge growth in right now. So we're talking specialty finance, we're talking asset-backed lending, a lot of different and interesting strategies, among others where Drew is. And that is what LPs are demanding right now, uncorrelated, strong returns from private credit.
Thank you. Drew, over to you. As COO, your responsibility is to hold the business together and make the realization of the strategy possible. It's a competitive business. Many managers trying to get into the private credit space. Atalaya is clearly an established and very mature shop. Talk a little bit about some of the complexities and changes that you have to deal with on a day-to-day basis that gives you that competitive edge, and how that would relate to somebody who's thinking about getting into the business.
I think the maturity of the business is an important point. John talked about the space, 20, 25 years ago, where maybe it was cool to have an investment strategy that was black box, right? And you didn't tell people what it was.
Right.
You have literally 180 degrees the opposite now. And I think the maturity of the business, like lots of other businesses, brings competition, brings fee pressure, brings regulatory pressure, brings investor questions. And I think you've seen, in general, a much stronger LP from a diligence side, looking at the managers holistically, where investment performance is necessary but not sufficient. And so you're seeing a much more robust effort to understand, know your managers, understand where they're strong and weak, understand where they're trying to grow. And those pressures are making it somewhat easier for established managers to sort of continue to elbow out some others, but there are some forces, I guess we'll talk about later, that are driving the maturity also in the space versus, for example, public markets and other strategies that are not seeing the type of growth that private credit is.
For a manager wanting to get into the space, right? There is building the platform to access opportunity, there's building the operating model, and then there's raising the capital, right? Mm-hmm. What's your viewpoint? How challenging would it be to get into the space?
I think I'm supposed to say very challenging. No one else should come in ever, under any circumstance. Terrible. No, I think one of the interesting things about private credit, I think, when people look at it on the continuum of hedge funds, private equity, the operations are different than buying 100 shares or buying 1,000 shares if assets grow, and somewhat different than owning a company, right, where you do a transaction and you're stepping in as a private equity fund, sort of being the management team. Credit has a little bit of an in-between, where you're, in some cases, acting like a bank, right, touching counterparties on a regular basis, having multiple different types of loans, having multiple participants, dealing with interest and print. So the operational complexity and the accounting systems and a lot of the kind of infrastructure that has been there for years wasn't really designed for private credit type transactions. It was designed for I bought 100 shares of stock today, I sold it, that type of thing. Even, bank debt obviously has become super established and relatively easy. The operations here is a little hard, and I think, we look at some of what we do as a little bit special and different that makes, engaging in the business a little easier and more customer friendly.
Yeah, let me put that back on you, Jess. Mm-hmm. Our business is helping managers with their operations and back offices related to the asset classes they're getting into, and what we're particularly seeing is a lot of your traditional mid-market private equity shops building out a private credit book and mm-hmm. being immense interest because they have the platform to access opportunity. Tell us a little bit about the due diligence side, what you see, investor focus, maybe your focus, and how you prepare managers, because as Drew just said, it's a very different animal than what they would be dealing traditionally, and have they built the robust operations to handle that? So.
Absolutely, yes. Thank you. Yeah, we work with managers that are both kind of on the younger side, on the fund 2 and 3s, as well as more established managers that are on their fund 5 and 6. So we see the whole spectrum. And I completely agree with Drew. The cost of setting up your operations and the complexity of it and the regulatory environment has become increasingly intense and difficult. Right? So it is not easy for someone to come in and set up a fund as it was potentially 5 years ago. So that is getting a bigger hurdle nowadays, which is one of the reasons why we're seeing a lot of successful launches on the private credit space being attached to an established platform. And in many ways, a private equity platform is a very strong platform, a robust platform, where there are a lot of synergies into the private credit space. It's not the same entirely, but there are certainly more synergies in terms of how this is working and set up. So yes, we have seen a dramatic amount of launches based on the private equity platforms, and they're very successfully so. And I think anyone that has an established private equity firm will be thinking about looking at launching an adjacent private credit strategy. And it makes a lot of sense when done correctly. We saw it 5 years ago where the hedge funds wanted to go into the private credit space. And it didn't really get the same traction with LPs,
Right.
for a lot of reasons. But it really does have a lot more traction when we do it from a private equity platform, which is promising, I think.
Yep, very much so. Just talking about those broader challenges, particularly to the management company, the manager themselves, John, there's compliance, there's regulatory hurdles. Talk a little bit about how you see some of those challenges based on your experience as being a COO.
Well, first of all, Jess and Drew set up a wonderful, sort of set of bookends to address your question, and I'm just going to fill in the middle a little bit. The synergies that exist with private equity is, to Jess's point, it's more natural, okay? But when I went to Apollo in 2008, and they were traditionally private equity, they had a little bit of distress. That wasn't the case. And even though Blackstone and a few others were doing it, that sort of transition for Leon, Mark, and Joss was quite breathtaking because they didn't understand that private equity operations, and by the way, when I say operations, I'm talking about everything that's not investment.
Mm-hmm.
There's 11 distinctive functions that Drew presides over, that I've presided over in my life, that don't lend themselves to the same types of natural synergies, for example, that PE and lending or structured finance or mezz, whatever you want to, the whole spectrum of that world, there's more natural overlaps. Not so much in the non-investment world. Investment operations are different depending on what the asset class is. Fund accounting is going to be different. The technologies and the systems. I could go on. And think about the service providers. It wasn't too long ago, pre-Madoff, that hedge funds were doing this themselves. And then the LPs had enough and said, enough already. There are organizations out there. So administrators in general grew up feasting on the world of hedge. They didn't focus on private equity.
Mm-hmm.
They didn't focus on credit per se. As a matter of fact, I would tell you that the industry is still evolving in that regard. However, the bottom line is very simple. These 11 functions that I mentioned, these non-investment functions, they're in desperate need of help. They don't scale, so the unit costs are just ridiculously high. Whether the LP pays the expense or not is irrelevant. The advisor, the GP can pay it, or the LP can pay it. It doesn't matter. It's still the cost of doing business. The business of running these firms is brutally complicated and does not lend itself to scale in any way, shape, or form. And the problem is the service provider community is coming to it late. Don't get me wrong. Hedge funds got mastered probably in 2009, 2010, where they were fairly ubiquitous service offerings. It didn't matter if it was State Street or Intertrust. The general offering was pretty much the same. But when you veer off now into those diversification plays, the PE firm that wants to now get into kind of what I call credit and credit trading even, or even financing, completely different set of issues they have to face. And don't get me wrong, they desperately try to do it internally, but the industry needs to step up, and the service provider industry, and provide that more holistic scale opportunity. It's not like audit firms. An audit's an audit. It doesn't matter if it's a potato or an apple. It's the same procedures, right? It's just a different asset class. But Drew can tell you that it's different.
Yeah.
At Atalaya, there might be 8 stripes of credit, and that's going to put a wrinkle through every single non-investment activity. So look, I lived that life for 25 years with some of the burliest and baddest players out there. When I left it, part of the idea was to work with my brethren to just basically share, if you will, those lessons, because they're not easy, and to really provide a message to the service providers like Intertrust and others that there's a huge opportunity out there, huge. And quite frankly, the growth of credit to continue, which has been extremely robust, is going to be a function of the advisor being able to support it. And they're going to look at you.
It's an interesting point. Sorry.
I was just going to say, we're hearing talk about how important it really is. And one of the things that I have seen changing in the fundraising environment is it's becoming much more of a hot topic. And so one of the things that we're doing in order to help the whole process here is early on in the fundraising process, we actually send in an external operational due diligence consultant to help our managers to prepare for what's going to happen when the LP decides to go on site. We have to keep in mind these fundraisers happens every 2 years or 3 years, and things change, right? Drew sees every single day, but there's an evolution on a daily basis within operational and the regulatory environment, and therefore we have to send in an operational due diligence consultant. We want to make sure that we don't waste the LP's time, and also we want to make sure that the GP is fully prepared and is set up to do things correctly. So it used to be something we talk about. Right now, it really is top of the agenda within a fundraising environment. So.
You want to add, John?
I've often said that, as you know, when you look at the crowding effect within credit in general, you know, we're talking about the world's smartest investment advisors. These are brilliant people. The innovation, if you will, that Jess talked about earlier, to give the client that extra 20, 30, 50 basis points of alpha is relentless. And as a result of that, and I turn it over to Drew to ask his view on this, it's not like operations, those 11 functions. I want to be clear, operations is not investment, it's 11 things. Every time, it's the butterfly effect. Every time something changes in the investment side, it ripples through Drew's world, my world in the past, for example. And people don't understand that. And what does that mean? It means there's more risk of error. There's more risk of just failing to meet your investor requirements in terms of reporting, and forget about the investment process in terms of covenant management, liquidity management, financial statements. I mean, this is a huge set of activities. And that's why, as Jess said, you know, when you pick your partner and you're comfortable, straying is not, straying's a high risk proposition, right? So you look at those, you know, I call them those 2,500 advisors or GPs, you know, there's really maybe 3, 4, 5, 600 maybe that are going to be the go-to players, you know, always. And don't get me wrong, the others will get smidgens of growth, but at the end of the day, that's kind of what's happening is this, I call it solidification of the asset class with the providers, and it will be very hard for these new spin-out folks, and I talk to them every day, by the way. Every day we talk to new spin-outs, and they're trying to raise money. Just tell them, I said, I wouldn't even put you in front of my allocator clients because you can't even have a coherent discussion, not only about what you don't do today from an infrastructure point of view, but you don't even know what the road ahead looks like.
Can I just, can I bat that one over to Drew? It's interesting because you talk about fund administrators there. One of the things that we see is partnering with a fund administrator is one solution, but we're also seeing, particularly in the private credit asset class, PE managers realizing that they need an internal version of the truth, right? Eyeball, A-ball, call it what you will, Drew. So, you know, when John's talking about the guts of operations, what are some of the things that you feel you need to have control of in-house that perhaps, you know, some people would assume that a fund administrator would take care of?
Well, I think it's a little bit of an evolving question.
Right.
I think there's, you know, the first dimension of the headwinds of the complexity that the business needs or the business requires. And then there's what are your available alternatives. So I talked a little before about the business maturing. I think the service provider communities are, you know, maturing as well. So that creates a little bit optionality to think about what's in-house, what's outsourced, what do you build, what do you buy. And I think there's a strong pull to try to think about what lends itself to scale and homogeneity. And it goes all the way from accounting entries to side letter terms to say, you know, you have a fund, $1.5 billion fund with 40 different large investors, and trying to have the conversation of, we really want our provision, not so much that I have anything problematic with your provision, but the scale of having the same provision so that we can manage it, and having that discussion. Years ago, that was a big issue in reporting, right? Where you said, I got to do my reporting a certain way. Not so much that I didn't want to report something else, but the bespoke idiosyncratic report created a problem. Technology has really helped make that easier. I don't see that as much of an issue, and I think managers in general are able to offer more flavors of ice cream, more slices of the apple to investors to satiate that. And those are the types of things that you're trying to balance. And to Jess and John, it's not easy, and it's fraught with risk. So when I look at it, I look at what are the things that are not fixable, what are the things that are, existential, what are the things that I can't reverse or have, and that's sort of the lens that I try to look through.
Yeah.
And it's not just me. I think one of the things that's really important in these managers is, you have 10, 12, 14 people who are all really capable. I think one of the things that I've learned myself is I'm not the best at almost everything that I do in the firm, which is great that there are other people who are really expert in all these other things. The idea that there's one person on the business side that's the epicenter, I really think that's the wrong design. It's much more the collection of expertise that whether it's in a risk committee or other things, that those things are intersecting and crossing, that you have a chance to make those decisions about what are the things I can't compromise.
Right.
And that's, I think, really the lens of what do I have to have in-house. So data science, as an example, has become something very meaningful as an advantage tool, right? And how do I say I can't outsource that? How do I think about that? And how do I make the trade-offs, as an example?
I think that speaks to what are you actually adding value to as a manager versus some of the fundamental activities that you can farm off to somebody else, right? Because your challenge is, I got to build for scale, I got to build for diversity, I got to build for ever increasing investor demands, I've got to build for potentially regulatory demands as well.
And I have to have redundancy around all those things as well. So, So those are, I don't think they're uncommon challenges in other businesses. They're just coming in our business now, commensurate with the maturing space.
Okay. I think one of the areas, what I find interesting is, the macro environment right now, the general consensus is that private credit has not gone through a cycle of rising interest rates or inflation or, as we say, war in Europe. This is sort of an open question to everybody in terms of how you see the asset class performing, growing, and the robustness against what's happening today. Jess, do you want to go first?
I'm happy to. I think first and foremost, a lot of people would conclude that COVID showed that private credit is pretty resilient. I think we came out of the COVID period with a very strong private credit, and we continue to grow. So that's first and foremost, I think, is very important. I think a couple of things we've seen on a macro level is kind of unprecedented, right? Inflation is probably, we haven't seen this for 40 years.
Right.
Not a lot of us were not here 40 years ago in the private credit space, at least. But what we're seeing from the investors, which is I find it very important, is investors, how do they react, and how do they react to the inflation fears? And one of the ways they're playing that is they're looking for real asset, hard asset type strategies. That can be aviation, it could be shipping, the steel, the value of the steel. So we're certainly seeing that. I mean, we are right now in the middle of a fundraiser with a shipping strategy. And that's exactly one of the things we're seeing is the investors demand it because I get a little bit of inflation hedge here, right? Mm-hmm. Just a little bit. And then, yes, interest rate hikes. We could argue for a long time how many hikes we think we're going to see this year. And we probably wouldn't get it right anyway. But what I would say is some modest rate hikes is not really going to disrupt us too much.
Right.
We have to bear in mind it's a floating rate instrument. So there will be some hedge or some protection there. Obviously, if we're getting a very aggressive hikes, we might have some companies that have difficulty in service their debt. Yeah. But then you play the other side of it. You play the more distressed and stressed. And I know, Drew, you got some thoughts on it as well.
We talk a lot at Atalaya about little rocks and big rocks. And I think some of the things you're talking about in market volatility are all versions of little rocks. And they all can come together and create some big rocks. And I think we generally think volatility is good. You don't want credit markets to shut off. You don't want extreme things. And so there's a handful of those things. I think the other big rock tailwind that is the sort of winning part of why private credit continues to grow is a macro force of, if you look at the public market, private market continuum and you say, how do I think about advantage, right, in core ways? You think about information analysis and execution as ways to think about advantage just in anything. And you look at the two and you say, hard to have a analysis advantage with so many smart people in competitive markets. Somewhat hard to have an execution advantage, right, because of technology and other things. And so you're left with really information. And private markets allows you to have an information advantage, right? And so that's, I think, the big macro force for why you're seeing this continued push. I know I'm supposed to say private credit's bad, everyone should go away, no one should do it, right? But I mean, all kidding aside, I think that's the big elephant in the room. And the other things in the volatility can be helpful because it helps to show investors not everything goes up and to the right. And having some of the stability and the uncorrelated and being a little bit more of the tortoise and making your 10 and making your 12 and doing that, right, that starts to show something really nice over time.
I agree.
Yeah. John, any thoughts?
Yeah, I mean, I'm in agreement with Drew on vol. I mean, vol's a good thing for like big boys and girls in the investment business. They know how to take advantage of it. Each have also mentioned, innovation. So as rates go up and, everything starts to change, this community will be hugely innovative and they're going to come up with answers and solutions. I would point out, though, a few things that haven't really been addressed in the industry, and that's the changes in regulation, particularly on private funds. There's a 341-page SEC set of recommendations. It's a lot of paper for a very short list of suggestions, but it's things like the performance calculations. It's things like certain expenses that are going to be barred or banned. It is a host of these quite punitive measures, and in part, it's because they're catching up during the COVID hiatus, and even I would argue a decade worth of the neglect, quite frankly, on some of these segments that have grown. Drew said it earlier. The banks are regulated for a reason by the Fed and others, right?
Right.
Lending. Okay. I'm not going to overemphasize lending, but any type of financing that a bank does is being done in credit, in private credit, and yet there's no regulation. There's no scale in a lot of these things. So I'm very fearful that the regulators, not just the SEC, but the regulators are going to issue some of these rules, and in the world of credit, they're going to have a pretty sharp effect on profitability, returns, and don't get me wrong, hurdle rates will have to go up given the rate environment. But see, the pressures that are going to be felt through either zealous regulation, and by the way, I'm a fair and balanced regulatory person. I believe there needs to be regulation. But I think the pendulum has swung a little bit, and some of these measures are very draconian.
Yeah.
I may take a little of the other side of, I think for the established managers, some of the regulations and the rules are good in that they establish the type of thing I was talking about, that there's a way to do things, there's a standard that has to be met, that there's transparency and consistency, and in some senses that helps allow tourists or requires tourists in the business to sort of go do other things. And so I think I look at it as a net good thing, and you can see that same design in the derivatives markets 20 years ago when the confirmations were the Wild West and there was all kinds of things to source and figure out, and over time that business matured till much more plug and play. And so I think there's obviously a regulatory balance, and it's hard to regulate. You've got, again, lots of flavors of ice cream. You can't have 400 different rules. So any rule you have is a little bit of trade-off around things, and I think that's what the regulators struggle with, is trying to find that right balance, that they capture most of the things most of the time, and the things that are really off-piste are the things that get escalated and caught.
Yeah, I wouldn't disagree with that, Drew. I think that Ivan might say something a little different if he were a $350 million manager trying to grow. And,
But
but
that's what I'm saying.
There's an unintended consequence.
I think that's right. I think
And and it depends on where you are and where you sit. My issue is really about the rather quick and unannounced. The SEC is typically, and other regulators are typically willing to drip into the marketplace their intentions, so that people can start thinking about it. We call it nudge theory, right? You drip in and people say, oops, this is probably a good thing to do. If the SEC or the ECB or other regulators around the world are talking about it, telegraphing one's intentions is always good. I find the overreaction in that set of recommendations my great concern. It's not, everything you said is 100% accurate, but you take that $350, $400 million credit manager, and they started with maybe 50 or 100. Now all of a sudden that expense base, Jonathan, is going to double, okay? And therein lies, again, the opportunity set for the industry.
Of course, right. And I think we can say that generally over the past 12 years, the onslaught of regulation has made it harder, right, for the smaller managers to really flourish in the space. Jess, do you have any particular viewpoint on that before we move on?
If I can look at it from a fundraising perspective, popular view or not, I actually find it a positive. Right? The industry has gone from very little to 1.2 trillion, going to 2.6 trillion. I think there needs to be zero question marks about how you calculate your performance or your risk factors.
Right.
And right now, it's a little bit in the gray zone. There are some nuances that may not be great for LPs, and I think LPs need that kind of trust in the robustness of the regulatory environment. And I do think it could be sharpened a little bit.
Yeah.
Like John, I do also worry about, are we going to swing the pendulum too far? But I can't influence it, unfortunately. So I will just trust that we will do the right thing and just create a little bit more of a regulatory environment that's going to be good for fundraising, because it will create a lot more credibility to our asset class, which is important.
Thank you.
Jess, I would invite you then to join me and others to issue a letter by April 11th, which is the comment period comes to an end. I'm sure there's going to be hundreds of them sent on this topic, and I think this conversation is representative of the way people think about these things. Nothing's right and nothing's wrong.
It's good. It's good. There's two sides to this, right?
But hopefully that comment process helps refine and evolve a little, that they get more right than wrong, and I think that's why that's there. And I think again, I think you're right. In general, thoughtful regulation is good.
Yeah.
Right. I think given the breadth of what needs to be regulated, it takes some cycles to get to thoughtful as you weigh through a bunch of things and you get into the nuances, and that process makes sense.
Yeah.
So
Agree.
Well said.
Yep.
Well said. Yep.
Brilliant. Before we end up today, I certainly appreciate the color everybody's brought. Any parting comments from anybody?
Any additional comments?
Any additional comments?
Can I ask you a question?
Sure.
Yeah. So we talk about private credit, and we all kind of think that Dodd-Frank is the main man who kind of really was a catalyst for private credit's growth. But could you name another person that is historically significant for our wonderful industry?
No, I could not.
And I'm sorry for putting you on the spot here.
That's okay.
Yeah.
thank goodness you didn't put me on the spot. This is great.
We're not over yet. No, actually.
I was hiding in plain sight right here.
No, and it's actually Henry VIII, who was a bit of a maverick in many ways, not only in his marriages and his view on church and state, but he was actually the first ruler of the world who said, lending is now legal as long as it stays within 10% of annual interest rate. Before that, it was illegal. It was usury.
Yes.
Now, so without Henry VIII, we would not have had the Industrial Revolution, because we couldn't have financed it. And we wouldn't sit here in our suits and ties and having a wonderful conversation. So we should not forget Henry VIII.
Shall not forget Henry VIII. Well, that's a great
Thank you.
ending comment. Well, thank you very much, Drew, Jess, and John, for your perspectives today. And thank you very much for participating and viewing this panel. Thank you very much. Bye.
Thank you.